Welcome to RBC's Markets in Motion podcast, recorded November 26, 2024. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. Today in the podcast, highlights from our 2025 U.S. equity market outlook, in which we reviewed the top 10 things we're thinking about as the new year comes into view. We're not going to go through all 10, but we are going to run through some of the more important highlights regarding our broader market call. The big thing you need to know. First, our year-end 2025 S&P 500 price target is 6,600. That's the base case and the path we currently see stocks on. We also run through our bear case of 5,775. Second, sentiment is modestly constructive on a 12-month view, but also makes the case for a near-term pullback. Third, we don't see much room for further PE expansion, but our valuation work still helps us understand how stocks can move higher next year. Fourth, U.S. equities may soon lose their appeal relative to bonds. Fifth, the U.S. economy is at an important crossroads from a stock market perspective. And sixth, the political backdrop presents both tailwinds and possible headwinds for the stock market. If you'd like to hear more, here's another 6 minutes. Well, let's be honest, it's probably going to end up being a little bit longer than that this week. While you're waiting, a massive thank you to all of our listeners who voted for us in the Institutional Investor, now known as Extel, All-America Research Survey in the Portfolio Strategy category this year. The results came out last month, and we were honored to rank number 3. Now let's jump into the details. We'll start with number 1. We're starting out with a year-end 2025 S&P 500 price target of 6,600. That's a gain of more than 10% versus Friday's close. Our bear case is 5,775. 6,600, our base case, is roughly the median of 5 different models that we use based on sentiment, our valuation and earnings work, the economy, politics, and the cross-asset dynamic between stocks and bonds. The outputs of those models range from 6,200 to 6,700. The story the data tells is that another year of solid economic and earnings growth, some political tailwinds, and some additional relief on inflation, which should keep the S&P 500's PE elevated, can keep stocks moving higher in the year ahead. We see our target as a compass, not a GPS, which we expect to revise as new information about the stock market backdrop becomes available. There's a decent amount of fog in the outlook as we head into 2025, however, and some of our models are close to levels that are typically worrisome for the direction of stocks or have been at concerning levels recently. And so we have spent some time outlining the bear case that we see. In our bear scenario, we estimate that the S&P 500 could end 2025 at roughly 5,775. We think that's a reasonable way to think about downside risks if some of investors' worst fears become a reality. Moving on to number 2. The sentiment setup is modestly constructive on a 12-month view, but it has been highlighting the potential for a near-term pullback. We remain focused on net bulls in the weekly AAII survey, where a move to +1 standard deviation above the long-term average has preceded each of the 5 to 10% drawdowns that have occurred in the S&P 500 since late 2022. Last week, the 4-week average was still below 1 standard deviation, but above the long-term average, a range typically followed by an 8.6% average return in the S&P 500 over the next 12 months. That does yield a potential target of nearly 6,500, which is baked into our base case. As for our bear case, back in October, net bulls crossed the 1 standard deviation mark several times. The 12-month forward return from that level is slightly lower, about 6.5%, which we've baked into the bear case. Importantly, when AAII net bulls are at the levels we saw back in October, stocks have typically been flat over the next 3 months, keeping us on guard for a pullback. Other gauges of positioning are more concerning. CFTC's weekly data on U.S. equity futures positioning has been hitting new all-time highs for S&P 500 contracts. Given what we're seeing here, we do expect a 5 to 10% drawdown in the S&P 500 before too long. Timing is tricky. Seasonally, stocks tend to be strong in November and December, but more prone to weakness in January and February. Next up, number 3. We don't see a lot of room for further PE expansion, but our valuation work still helps us see how stocks could move up in 2025. To gauge valuation, we focus on the results of our proprietary model, which forecasts a year-end trailing PE based on assumptions for inflation, interest rates, and the Fed, based on relationships dating back to the 1960s. For our 2025 price target, we're leveraging the version of this model that bakes in RBC House views for 2% PCE, only one more cut from the Fed, and 10-year yields of around 4.6%. Those inputs anticipate a trailing PE of 22.7 times, which implies a year-end level on the S&P 500 of 61.61 on our own 2025 EPS forecast of 271. That's the most conservative of our 5 target inputs. The PE implied by our 6,600 target, however, is obviously a bit higher than what the model, this valuation model at least, calls for. And that's a little above 24 times, similar to where we've been trading on 2024 EPS recently. For our 2025 bear case, we are incorporating one of our model stress tests, which bakes in inflation that reignites to 3%, no 2025 Fed cuts, and a 10-year yield that rises to 5%, representing some of investors' major fears. This exercise produces an anticipated year-end PE of 20.8 times, or year-end price level of 56.31 on the S&P. Moving on to number 4. U.S. equities may soon lose their appeal relative to bonds, but they haven't done so quite yet. Investors have been worried about a vicious rotation from stocks to bonds within the U.S. for quite some time, but it simply hasn't panned out. Regarding this topic, we've been keeping a close eye on our earnings yield gap model, which as of late November was at minus 0.3%, still within a range signaling gains of 12.7% in the S&P 500 over the next 12 months, or a year-end price level of more than 6,700. We included that projection to our base case price target calculation. But our earnings yield gap model is admittedly starting to run out of wiggle room. If 10-year yields rise to 5% or more, the earnings yield gap will be back in a range where the S&P 500 has typically fallen 3.2% over the next 12 months. That would take the S&P 500 to a bit below 5,800 in terms of price. We've added that scenario to our bear case calculations. Next up, number 5. The U.S. economy is at an important crossroads from a stock market perspective. What assumptions we should use about the U.S. economy for 2025 is debatable, contributing to the fog in the outlook that we see. Currently, consensus anticipates real U.S. GDP will come in at 2% in 2025, a number that has been moving up. Meanwhile, RBC Economics has been looking for 1.9%, and the latest Fed SEP called for 2%. Given the modest improvement in consensus U.S. economic forecast that's been seen recently, the likelihood that the passage of the election and the easier regulatory backdrop can provide some tailwinds, and the tendency of the economic consensus to start out with GDP forecasts that are too low in the post-COVID era, in our base case for our 2025 price target, we assume that real GDP will be able to get over the hump into the 2.1 to 3% range. This is important because it tends to be a healthy backdrop for stocks with an average return of 10.7%. In our bear case, however, we've baked in where GDP forecasts are right now, within the 1.1 to 2% range that has historically produced mixed stock market returns. The S&P 500 has been up 40% of the time in this backdrop, with an average annual decline of 3.4%. Wrapping up with number 6. The political backdrop presents both tailwinds and possible headwinds for stocks in the year ahead. We see the U.S. equity market as being in a discovery process regarding the domestic policy platform of the new administration, something else contributing to the fog in the outlook that we see. Deregulation and improved business activity in the wake of a clear outcome are obvious tailwinds. But otherwise, right now, we simply do not know what the new administration will do in regards to its campaign promises on taxes, tariffs, and immigration, or the extent to which they will do them, and it's going to take some time to find out. In our base case for our 2025 price target, we've baked in the average annual S&P 500 return in years that Republicans have controlled the White House and both chambers of Congress, which is 10.9%, one of the best backdrops for stocks in terms of the balance of power. This implies a year-end 2025 price level in the index of nearly 6,600. We think including this stat in our target does a good job of capturing the impact of better vibes that may emerge post-election. In our bear case, we bake in the 2018 annual return of the stock market, a decline of 6.2%, the only down year of Trump's first term, which was actually one of the strongest presidencies on record for the stock market. But 2018 was a year in which U.S. equity futures positioning on CFT's data became extremely elevated in January, similar to what we're seeing right now. after the S&P 500 rose nearly 20% the prior year in anticipation of the passage of Trump's tax cuts. A few things hit the stock market in 2018, including the low vol unwind in the first quarter, the realization in the fall that the China trade war could actually be bad for the U.S. economy and U.S. companies, and concerns about the Fed's hiking cycle and QT program, which came to a head in December. It's not a perfect analogy, but it does remind us about some important things as we contemplate risks that may lie ahead. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.